What if I told you there was a way to sell covered calls at the money for maximum juice, but still have plenty of upside potential? Does that sound impossible? Well, in this video, I'm going to teach you the ultimate options hack to take your covered calls income to the next level. Let's take a look at a recent trade example in Palantir. So here's the secret. On Monday, I sold a covered call on Palantir right around this level when the first 5-minute candle closed below the 9 EMA on the 5-minute chart. Now here's the real kicker. When I sold that call, I sold it naked. I didn't have the shares yet. Now before you say, oh wait, that's way too risky, just hang on a moment, okay? Hear me out. I didn't just sell the call at the open or early morning. I waited for late morning after the initial hour or hour and a half, and I waited until the price started to show weakness. So in addition to the price closing below the 9 EMA, I also look at the MACD. The MACD was below the signal line. The exact MACD I'm using is the 395. MACD, and I got rid of the histogram. You can do that by going to the Style tab in Trading View and just uncheck histogram. And the third condition, and this is extremely important, I need our stock to be underperforming the S&P 500. So the indicator that I'm using to show that the stock is underperforming the S&P 500, let me pull it up. It's the Auto Comparative Relative Strength by SJAKK, this one. Now with this indicator, you have two lines. You have the relative strength itself, which you see here in purple, and you have the moving average of the relative strength. And the requirement is that the relative strength is below its moving average. So here you see the purple line below its moving average. So that is the third requirement to sell a covered call. So once again, let me summarize. We need a 5-minute candle close below the 9 EMA. The MACD line should be below its signal line, and the relative strength of the stock has to be underperforming the S&P 500. Let me just show you what settings I have on the relative strength indicator. So over here in the first part, you want to make sure that you have this override box checked. And you're just going to go over here and you're going to type in SPY, hit enter. So that's going to make sure you're comparing your ticker against the SPY. And we want a period of 20 and a moving average period of 10. Okay. And if you want to simplify this, you can actually just get rid of the MACD. Okay. These are the two most important components: the 5-minute candle close below the 9 EMA and the relative strength underperforming the overall market. Now notice how that morning, Monday morning, Palantir was actually outperforming the S&P 500 until about 10:05 a.m. And you're going to see that a lot of the time because in these high IV, these high volatility stocks, that's going to be the case a lot. It's going to pump in the morning and then there's going to be profit taking. And while there's profit taking, it's going to start underperforming the market. Now let me just address those of you who are thinking, wait, this is way too risky. If this takes off, our risk is uncapped. First of all, we're in late morning. We've waited for most of the volatility to die down. Okay, second of all, if the price at that point, after it closes below the 9 EMA, if price then turns around and keeps moving higher, well, guess what? As soon as there's a close back above the 5 EMA, and as soon as the relative strength starts to outperform the S&P 500, in other words, when the CRS indicator moves back above its moving average, at that point, we will buy the 100 shares and we will complete the covered call. Now, if that happens and we don't get the big pullback that we want, most of the time, our covered call short strike is still going to be pretty close to our entry price on the shares. So most of the time we'll be giving up a fraction of a dollar and maybe $1 or $2 worst case scenario. And of course with this strategy, you absolutely want to avoid big news conference events. For example, if a company has ongoing news or some big event, obviously you want to stay away from trading this strategy on that stock. So let's say this naked short call option is going in our favor and we see our P&L going up. The question is, well, when do we buy the 100 shares? Well, the answer is very simple. Let's see when our indicators crossed back above and became bullish. So in this particular case, that happened right here. The price closed back above the 5 EMA, and both the relative strength and the MACD were above their moving average and signal line respectively, right here. Now, the beauty of this is that we are gaining upside potential on a covered call that's at the money. This isn't possible if you execute a traditional covered call. Look how much extra juice we're getting. There's our entry. Now this distance right here, this distance is additional upside that we would not have otherwise gotten. Look how much this is. This is from 92.76 to 94.83. This is about $2, $2 extra of upside. That's $200 in additional potential profit on the upside that we would not have otherwise gotten. And not only do we get that extra profit potential, but we lower our break-even point by $2 whole. So the call option that I sold up here was a 4 DTE. I sold it on Monday and it expires this week. So for that 4 DTE, I got $350 per contract of premium. That means that for a traditional covered call where you enter into the shares and you short the call at the same time, your break-even price would be $95 minus $3.50. So your break-even price is $91.50, right around over here. That's not bad, but look at how good our break-even price is. Our break-even price, by waiting for the strength to return into the stock before buying the 100 shares, we reduced our break-even point by $2 whole. So our break-even point is going to be $89.50 all the way down here. That's our new break-even point. So we're getting up to $200 more in potential profit, and we're lowering our break-even point by $2 whole. And sometimes stocks that gap this much, price will actually erase the whole move and close the gap. So sometimes you're actually going to be able to get up to an extra $5 to $10 in appreciation. Just imagine selling a call at 95 and buying shares at 89. And that happens sometimes. Let's take a look at another example. So this was literally just a couple of days ago in the same stock, Palantir. So our first indicator crossed really early on, but as you can see, the price was still well above the 9 EMA. And then later on, the relative strength crossed below its moving average. But we're still not selling the call because we haven't had a close below the 9 EMA. And here we did. And this was at 10:40 a.m. And it's generally going to be late morning or early afternoon when you're going to see this level of profit taking. So we'd probably sell the 85 call. And for the next 2 hours, we see that beautiful P&L rising. So when do we buy the 100 shares? So by now, I think you know the drill. Do we buy them back here when we get the close above the 9 EMA? Pause the video and let me know if you would buy the 100 shares here. If you answered no, then you're correct. We do have a short-term momentum shift in the MACD, but as you can see, the stock is still underperforming the S&P 500. Pause the video and see if you can find the correct entry. If you said right over here, then you're correct. We have a close above the 9 EMA, and we have very clear bullish indications from these two indicators, both above their moving averages. let's say that we did a 3 DTE, and let's say we got about $300 of premium. So based on our entry, our break even would be about $78. So I'm going to draw our break even right over here. Now, if we hadn't waited for price to move down, our break even would be all the way at $82. So let's see how this 3 DTE played out. So we're looking at Tuesday, and there's Thursday. So let's see what happened that Friday. Where did it expire? Price expired all the way up here. So we were able to get the full $300 in premium. And for those of you who are not super comfortable with covered calls, if you wait till expiration, you're guaranteed to get the full premium, no matter where the price is with respect to the strike. So in this example, we get that full 300 premium, which is really good for only about 4 DTE. And we got about $420 in capital appreciation.
Love.
It's okay, I can edit it out. Maybe you know what, maybe I won't edit this out.
Why?
I don't know, because people always edit. I don't want to do things like everyone else, you know? I want to be different. So obviously you're not going to get the full premium every time. You're not going to get the full capital appreciation every time. Sometimes the trade will be a loss. Sometimes it will be a partial gain. But let's take a look at what this looks like in terms of return on capital for those times when we do get the full capital appreciation and the full premium. So we would have paid about $8,100 based on the entry price per contract. So the $720 profit divided by 8,100 is going to be a return on capital of 8.9%. And that's in 4 days, guys. Once again, that's not going to be your result every time. That's probably only going to be your result about 30 to 40% of the time. A small percentage of the time it will be a loss, and the vast majority of the time you will have a modest gain of somewhere between 0 and 8.9. But that's in 4 trading days. If you can average just 1.5% in a trading week, you're looking at an annual return of about 100%. Now granted, that means you always have 100% of your account equity in play, which may not always be the case because you may not want to be that aggressive. But that being said, this has a huge return potential. Something else I forgot to mention is that when you're implementing this kind of strategy, you're actually going to notice that even early on in your position, both your shares and your short call are going to be appreciating. What you're probably used to is seeing either your shares going up while the short call is decreasing in value and losing money, or the other way around. With this strategy, sometimes you get to have your cake and eat it too. Now, let me just rant for a second, if I may, and it's my channel, so I think I'm allowed to. Absolutely every YouTuber who makes videos about option selling in the space, absolutely every single one of them, they take the best case scenario and they extrapolate it for the entire year, okay? But on my channel, I'm not gonna blow smoke up your ass. There will be absolutely no smoke blowing up anyone's ass on my channel. And if you want to follow my trading, if you want to see what stocks I'm buying, what covered calls I'm selling, check out my Ko-Fi page in the description. I make several timely posts every single week. I create a fresh list of all the highest volatility stocks, and I look for setups every morning and every afternoon on the juiciest premium stocks out there. Feel free to leave any questions in the comments. I'll reply to every single one. Thanks for watching, and I'll see you in the next one.